Hello, we are Women Educating Women, and today we are talking about hot topics in our respective fields. So, as before, we have me, Cheryl Smith, as a realtor and business owner, Sujin Kim as estate planning attorney, Tara Van Zant, CPA, and Ava Carnival, investment advisor. We're going to hear from Ava first, who is going to be talking to us about CalSavers. Ava?
Thank you. So CalSavers is quite a hot topic right now in the financial planning and 401k industry. And what it is, for all of our California viewers, CalSavers is a state-mandated IRA program that started rolling out in the voluntary phase in 2019. What it says is basically any employer that has 5 or more employees over the next 3 years is going to have to eventually set up a 401k plan or enroll in CalSavers. Now, the point of this was to encourage business owners and companies to put something in place in order to allow their employees to better prepare for retirement. So, if they're not going out on their own and creating an IRA or contributing to their retirement or saving their money, they should be able to do it somehow through their employer. The key point here is that if you're watching this and you are a business owner in California and you have 5 or more employees, that deadline is going to come up in 2022. The next deadline is for employers with 50 or more employees. That is coming in June 30th, 2021. They will need to do something. The deadline for employers with 100 or more already passed last September. That's just something to keep in mind, knowing your options. If an employer does not put in a program or enroll in CalSavers, they will be subject to penalties from the IRS. So it's just something to keep in mind if you are a business owner and you're kind of in that position. I would suggest you reach out. I'm happy to explain the difference between the two options. If you're an employee of a company that may be enrolling in CalSavers, there's something important to know about what that means for you. Basically, how it functions is like a normal IRA does. So the limits are the same there at $6,500 per year. And what that means is that you're going to have to calculate based on your income whether you're allowed to or not allowed to contribute. So it's a lot of math. It's based on your income, and it's up to you to figure it out. Otherwise, you'll have refunds and penalties. So each year, if you are part of a CalSavers company, you will have to opt out or you'll be automatically enrolled into the program. So it's a lot of things to keep in mind as an employee of those companies. If you have an IRA outside of the one through CalSavers through your company, you can contribute to both, but just not over the maximum limit. So just keep that in mind as well. Otherwise, most companies will have a 401k. So it's exciting news for employees that, their companies will have to offer some form of saving for retirement. And those are just some of the main questions I've been getting over the last 6 months or so.
Okay, well, it certainly sounds like there's a lot of responsibility that's placed on both the business owner as well as on the employee. What a surprise. Okay, so now we will go to Tara Van Zant, who will be talking to us about tax-related items associated with the coronavirus. Tara?
Yeah, so well, you know what time of year it is. So I'm going through tax season. So it's definitely an important topic because there were so many bills passed last year that had provisions in them that changed your tax return. And then also there's been bills passed during this year that even affect your tax return for 2020. So it's just important to kind of know the things that might affect you, basically. So the stimulus payments, they were just passed, actually, a third batch of stimulus payments, and they're $1,400 per person. Those are actually already going into people's bank accounts, and then they probably will be going out later in check form too. They're for people who make under $150,000 as a married couple or under $175,000 as a single person. The other thing that has to do with the stimulus payments that is important is that if you didn't get them in 2020, you can take them on your tax return now. So that's also important to know. That threshold wasn't 150, it was higher. It was about 200,000. So it's important to know that, just to know to look for that, talk to your tax preparer about it, because you may be able to get that money now too. And then there's also some things for businesses. The PPP loans are important, the taxation of those. The IRS has said you can take deductions even if you paid for it with PPP loan, but the states are all over the board on it. So depending on what state you're in, it may be different than that. So that's also important to know. California has not passed anything yet as far as allowing you to deduct anything. They're still waiting on that. They started something, but they haven't finished it. So you probably have had some people will have their returns extended to account for that as well, because California started it, said you could probably deduct it, and they put a bill in place, but they haven't finalized it. So it's important to know that. And then also on your payroll tax returns, there's an employee retention credit that was only about $10,000 a year when they first passed it. And now it's gone up to basically $28,000 per employee per year. So it can be a large amount of money. It's a credit on your payroll tax return. So, and I've noticed a lot of payroll companies don't always ask about it or don't always capture it. So it's important to talk to them about it if you think you qualify for it. And you can even go back and amend returns into 2020 to capture that credit if you didn't get it. Because a lot of companies weren't getting it because initially you couldn't take it if you had a PPP loan. So those are just kind of the large questions I'm getting these days, and a lot of the topics that I'm going over with people. There's all kinds of other things. Unemployment is exempt now because of this new bill. There's a $10,000 exemption for unemployment. So, but then there's just all kinds of other things, and all the bills are different. So definitely talk to your tax preparer and understand what's going on with how you're affected by it, because I can guarantee you're affected in some way, because there's so many provisions that almost every single person is affected in some way or another.
Well, I am so glad to hear, as I'm sure many other people are, that you can go back if it was not covered by your tax person and you've already filed your taxes. It's good to know that there's some sort of a look back provision. Disclaimer that I did not say at the beginning is that this is not legal or tax advice that you are being given. It's just general information, a chat amongst professionals. So if you have specific questions, you need to check with your tax professional and or attorney for those kinds of things. All right. So next, let's hear from Sujin, who is going to be talking about CalAble. Sujin?
Yes. Okay, so this is one of the hot topics, I think, in estate planning right now, and it's really exciting. So CalAble, it stands for Achieving Better Life Experience, and the intention was there are members of our society who have a disability, and as such, they receive government benefits. So a needs-based government benefits, whether it's Medi-Cal or SSI, something to that effect. Because of the stringent requirements, like Medi-Cal will only allow you to have $2,000 a month in assets. Some things are exempt, like your home or your vehicle. But with those strict requirements, the people that are receiving those benefits, it's really difficult for them to, one, have estate planning, and two, for them to save money, because if you have too much money, then you'll be disqualified from your benefits. So that doesn't seem right that these people are receiving these benefits because they need it. It's a needs-based program, but at the same time, they're unable to secure a financial future because they are afraid that they're going to be disqualified if they have too much money or if they save it in the wrong way. So CalAble is a program that California rolled out in 2018, and it's actually a really neat program. The funds that are held in these accounts, it can be invested. You can choose like the aggressive model or the moderate or conservative, and you can have money in their assets in there and it won't be attached. So when someone is receiving Medi-Cal benefits, the thing that they worry about most is that, yes, during their lifetime, they're going to get that benefit. But once they pass, Medi-Cal tries to seek repayment from the estate. They don't want their estate to have to pay that back, and everyone's always kind of weary of, do I have to pay it back? Am I going to fall under the guidelines? But with CalAble, they're able to save money and it doesn't affect their SSI or Medi-Cal benefits up to a certain extent. So they can have up to $100,000 and it doesn't impact their SSI benefits. And this is a really good way for them to take ownership and to be responsible for themselves and to be able to spend their money or save their money in an account that is supposed to work in conjunction with their government benefits. So that's really great news. But some people will ask, well, instead of having a special needs trust, which is an irrevocable trust set up for someone with a disability, I'll just take a CalAble account. Well, I think they're better used together because CalAble has some restrictions. For example, you have to have had the disability before age 26, and you can only contribute up to $15,000 a year. And like I said, you can have up to $100,000 without it affecting your SSI benefits. So for example, I have a client right now whose mother passed intestate. So she passed without any estate planning, but the daughter is receiving SSI and Medi-Cal benefits. So after her mother's estate goes through the long and costly probate process, then my client will be due 1/3 of $500,000 because that's the value of her estate. Her brothers can take it and they're happy to take it. But if my client takes it in full, which she has to, because it'll just be distributed in probate, that's how it'll be distributed, then it's going to impact her benefits because she's coming into over $100,000 in cash. So the better approach would have been for her mother to have created a special needs trust, which is an irrevocable trust. That means with the mother's assets, she's creating this irrevocable trust. The daughter cannot access it. She cannot touch it. She cannot maintain it. So it's not her asset. It's being managed for her. If it would have been funded into that special needs trust, then that doesn't count against her government benefits. So she could have received her inheritance that her mother wanted her to receive and still continue to receive those benefits. But now she's kind of in a pickle because if she takes the outright distribution, she could lose her benefits. What are her options now? Is to either set up a first party special needs trust, which means after the money is distributed to her, she says, I want to create a special needs trust for myself with my own assets. But what happens with those trusts is that after the person passes, Medi-Cal can claim for repayment, which kind of defeats the purpose of her being left an inheritance to provide for her. So during her lifetime, she can use it, but Medi-Cal will attach. And that's the difference between planning ahead and then not having a plan. So there are ways that she could take advantage of CalAble, but she has to stick with that $15,000 annual contribution limit. So if she's due over $100,000, then that's not exactly the best way for her to do it. I mean, she is considering possibly just waiving her inheritance and giving it to her brother and hope that he takes care of her, that he, keeps his word and provides for her during her lifetime but I mean, that's not what the mother had intended. She wanted to provide for this daughter and she really does need the assistance. So it just makes that difference of if the mother would have created the third party with the mother's assets, the third party special needs trust, the daughter could have had both the benefits and her inheritance. Now, if she has to do a first party special needs trust, she's, facing some challenges there. And if not, then, she could lose her benefits, which would be, tragic for her. There are ways now that people with disabilities can save for their future or invest, and even, doing so without risking their benefits, but it all requires planning. So I really do suggest if anyone has heard of CalAble and if you're interested and if it seems like something, if it's perked your ears, then you probably have a need. So I would encourage you all to reach out to an attorney and just get all the information you can, because you have to do it before you pass.
So we have now heard from 3 different people, all talking about complex topics where people are responsible for knowing certain things that they may not know. So getting representation is important to your wealth building. I, as a realtor, Cheryl Smith, am going to address the topics that are coming up on the real estate side. The first is, are home prices heading up or down? That would be number one. And no, I don't have a crystal ball, but today's prices are happening because of two factors. One is the low interest rates and the other is the low inventory. So people say, oh, is this like 2008? This is nothing like 2008. 2008 was a response because of the tie-in to real estate with the stock market. These factors of inventory and interest rates are normal factors in the real estate market. Lawrence Yun, who's the chief economist for the National Association of Realtors, gave the forecast that he expects to see a 9% jump in real estate sales in 2021 and a 3% rise in home values. Now that's nationally. In California, we know we're in a different realm, but it does say that increases are expected. The other thing is that because of the uncertainty, people tend to not take action when things are uncertain. And now that the vaccine is beginning to roll out and what have you, the thought is that the spring selling season is going to go into the end of 2021 because as things begin to return to normal, people will begin to spend the money that they haven't been spending while they were locked down. And that is what is going to extend the strong selling season in 2021. Now, if you are thinking of selling a home, you might be curious to know, what should I do to improve my home? According to Architectural Digest, the number one thing is a home office. With so many people working from home, having your laptop on the kitchen table is not what people are looking for. They're looking for dedicated office space, dedicated lighting, because they're no longer in an office. Their home is their office. The second thing is outdoor space. People still want to entertain, but don't necessarily feel like it's safe within their home. So when they have a beautiful backyard or patio or deck, then that allows for the socializing that they want. And also kitchens are important, not the complete remodel that you think of, but to have different configurations within the kitchens because we are staying home more. We're not going to as many restaurants and you still want to have beautiful surroundings. And then lastly, to have thoughtful lighting, updated fixtures, and warm paint colors so that that time that you do spend at home is more enjoyable. The last thing that I'm going to touch on is Prop 19, which goes into effect April 1st of 2021. Now, there are other things about Prop 19 that can be addressed later, but what I'm going to address is hopefully going to affect this inventory shortage that we have. So people who are age 55 or more, severely disabled, or victims of wildfire or natural disaster, and have their home as a primary residence that they are relinquishing, and that home can have the homeowners exemption, and the home that they buy, they complete the purchase within 2 years after they sold the old one, could be eligible for tax savings. Again, I'm a realtor. I am not a CPA, so you would need to consult your tax professional. I am simply giving you an overview of Prop 19 and why you might care about it. Now, the home that you're buying can be in any county in California. It can be of lesser value, equal value, or even greater value than the home that you relinquished. And you can do it up to 3 times, or if you're a victim 3 times or more of a wildfire or natural disaster, it's unlimited, the number of times that you can take advantage of it. So as more people who are eligible take advantage of the tax savings that they can realize through Prop 19, after April 1st of 2021, that should free up some inventory for the home buyers to have more options. So Prop 19, I hope that you will take advantage of it if this is something that you want to be closer to family, grandchildren, whatever. It is in California. So that's my hot topics. So I hope you've learned something today. We all hope you've learned something today. If we can be of assistance in our respective fields, then please do reach out to us. You will see our contact information at the conclusion of this presentation. Thanks so much for listening. We'll see you next month.